Hey, this is Brant from Wolf on Wall Street Trade with a market update for March 22nd, 2019. First, let me say thank you to the new viewers, the thumbs up, the comments, and to subscribers. Thank you very much. You guys have been fantastic over the years. I absolutely adore all of my subscribers. I have just the best people in the world, and I'm so happy to do this every day. So this is a daily chart of the S&P 500, and last week was the FOMC. The two major things, in my opinion, were the Federal Reserve, the FOMC, which has sent the market higher all through the year, and global flash PMIs, manufacturing specifically, at the end of the week. I've got a few trend lines. This is a pivot low here. This area around 2817 comes off of the October 17th high, and this is an area of interest, let's say, that technical traders are watching. You can see it's been kind of an area of resistance here, support, resistance, 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 and it's kind of where the market has been tangling with this area for about 4 weeks. Matter of fact, if we look at a weekly chart, and I'll zoom in here, you can see the level here. So 1 week, 2 week, 3 week, 4 week has poked above a couple times, and my feeling has been like this is just an ideal area to squeeze shorts and to act as a bull trap for new longs who didn't want to participate in this rally. And we saw that with global fund flows. They were selling all through this, and then last week the biggest inflows in history, second biggest inflows in history. So let's go back to that daily chart. So we have Monday, Tuesday, Wednesday, Thursday, Friday here. Typically on a Federal Reserve week or FOMC week, the volatility will be crushed, and it helps stocks support stocks at least, and we really didn't see a lot of reaction here on Wednesday to the FOMC, and we had this big huge move higher on Thursday. Really odd move. I think it was really a bailout of the market, to be quite frank with you, and I think it also served as a big bull trap, because if you look at what happened here on Friday, just a mess, right? Really bad selling, small caps, financials just absolutely hammered, and we took out, let's see, 1, 2, 3, 4, 5, 6, 7, 8 days of longs there. By definition, that is a bull trap. That's kind of what I expected was going to be happening in this area, and came down to this 2800 area that I also have marked. It's just a psychological level. So let's take a closer look at the week. I'm going to use a 5-minute chart. So here's Monday, Tuesday, Wednesday, Thursday, Friday. This is the FOMC knee jerk here. I'm not going to get into a lot of the details for members. You know, there was some crazy stuff going on this week. So Monday, as prices came up here, one of the first things that I saw happen Monday was volatility's term structure started flattening, meaning there was a lot of hedging going on, and that was being reflected in the term structure of VIX futures, and that caused this sell-off. Then on Tuesday morning here, same thing happened. So volatility's term structure started flattening. We also saw volatility relative strength. I mean, it's so minute, you have to look at it with a microscope, or you have to really pay attention to it every day. But it was a warning here. There was a warning here. This is the sell-off or decline into the FOMC. It was much uglier in places like small caps. You can see there. Let's go back to the S&P. And here is the typical FOMC knee-jerk reaction right here. It ran up, and there were some short-term trend lines that these were hitting all the averages. And the first place I saw some trouble was in small caps on 3C charts. Declined the rest of the day. This is not a great reaction to the Fed, which just went as dovish as it can really go. At this point, you know, the next thing for them to do is a rate cut. So it was a very, very dovish Fed. The knee-jerk reaction here, this is typical. I always warn, be careful of these knee-jerk reactions. It faded to the end of the day. And futures were down Thursday. As a matter of fact, Dow futures were at the lowest point in a week. Global markets didn't look good. And you really had no hint at all of this big move on Thursday, except that VIX futures were being crushed in the pre-market. So we saw some of that VIX hammering in the futures before the open, and then this move just out of nowhere. To me, it looked like a rescue of the market because of this fade after the FOMC on Wednesday. In any case, on Thursday, very, very strong day. I'm not taking anything away from it. And, you know, how do you know this is a bull trap? You just don't. The only thing I said on Thursday was, you know, we had 10 of 11 S&P sectors up on the day. Financials were the only one that were down. They were down 1/3% by the close, but they were down 1.5% earlier in the day. And what I said on Thursday to members, I said I would be absolutely terrified if I was a long investor buying this when you have a bear flag in the financial sector. This is Thursday. Here's the morning sell-off there, down about 1.5%, closed the day. Just down 1/3% with a bear flag. That is the second most heavily weighted S&P sector behind technology. So when you see this kind of really strong action and kind of a breakout to a new high for the year, and then you have the financial sector in a bear flag, to me that's just, like I said, I would be terrified to be long, and these guys were just wiped out on Friday. Now the question is why? Well, you can say it is the global PMIs that continued to contract. They're in contraction. Markets ignored all that. So the one thing that did happen on Friday, and that I've been warning about this for months with the treasuries and what the yields are doing, is that yield curves inverted, specifically the 3-month, 10-year spread inverted. Historically, that's basically about 100% chance of recession on average over the next 12 months. I think the most important takeaway from that is that it changes the mass psychology, and as we saw Friday, now paying attention to the global weakening data that has been going on through this entire thing, and now that the yield curves have inverted, they're paying attention. So let's take a look at some of these on weekly charts. Here's the S&P 500, and here's that area it's been tangling with. So this is how it ended the week, down about 0.75%. The NASDAQ 100 put in a shooting star. So it was almost unchanged on the week, up 0.3%, which is just negligible. Like I pointed out last week, you strip out that FANG weighting, so QQQE down 0.60%, the NASDAQ composite down 0.60%. So the FANG weighting is really what has kept the NASDAQ acting a little bit better. The Dow Jones Industrials down 1.3% on the week. So you notice lower highs here. And the worst was the small caps. So these are down 3.33% on the week. Oh, that's an ugly chart. Let me clean that up. Okay, so here's the weekly chart of IWM, keeping these trend lines a little bit more simple. So we saw that break of trend lines, back testing, and look at these candles. So we got lower highs for 3 weeks, and we've got lower lows. Small caps tend to lead the market. Everybody focuses on the FANGs. I would rather know what international paper is doing than what Facebook or Apple or Amazon are doing, to be quite honest with you. It's a lot more telling. Let me show you one other thing, volume. So here's the daily chart of the SPY. Here's volume in the bottom. So here's Friday, huge volume on that sell-off. Let's take a look at QQQ. Again, huge volume. Let's take a look at IWM, huge volume. And let's take a look at the Dow, huge volume, bear flag over here. As far as S&P sectors, we had 6 of 11 down on the week. The worst performing was the financial sector. So let's pull up XLF. It was down 4.88% on the week. There's a bear flag. Look at this huge volume in XLF. The material sector was down about 2%. Industrials are down about 1.5%. We have a bear flag in industrials as well over here. Healthcare was down about 1.5%. Energy was flat. The sectors that were up, technology ended the week 0.5% up. Consumer discretionary almost 1% up. And then we had all the defensive sectors up. So real estate up 1%, consumer staples up 0.7%, and utilities up 0.5%. The worst performing ones were these front end cyclicals that I pay a lot of attention to. Here is the Dow transports that I've been talking about a lot recently. So these were down 2.5% on the week. And let's go to the ETF IYT. Look at the volume in that. Biotechs were down 5.25%. That was due to BIIB. Retail down 2.2%. And the worst, what I kind of ended the video with last week, I said, pay attention to this, the regional banks, okay, because they had a bear flag, actually the second bear flag. So regional banks, here's a 15-minute chart. This is their uptrend that they broke, formed a bear flag, broke. This is what I pointed out in last week's video. They ended the week with a bear flag. They actually showed some relative strength on Monday. Walking this forward, the 15-minute chart, there's Monday. Doesn't matter to me. They're still in a bear flag. And here's what happens through the rest of the week. Remember this bear flag? I said it had a downside target of 52.50. Here we go. Boom, just absolutely blew through it. Basically what we have here is that regional banks broke down sharply, formed a little consolidation here. I think this was Thursday, broke down again. So this is actually a second leg lower. Couldn't really tell what this was in regional banks, but as I pointed out earlier, it was very clear in the financial sector. There it is, little teeny bear flag, and broke down again. So regional banks down almost 10% on the week. And this is just monster volume. I think that is the heaviest actually since they were selling off in December. And these are the kind of sectors I've been saying, watch out for. So a lot of warnings in volatility early in the week. They were subtle. So what did VIX do on the week? Wow, man, almost up 30%. And for a week, where you have the FOMC and volatility is usually smashed. Look at it from, I think, Tuesday here. It's making higher lows and higher highs. And then this huge day on Friday, up about 21%. So volatility absolutely soared. And Treasury yields got crushed. So let me pull up the SPY. I've been warning about this for quite a while. So here's the SPY. I'm going to zoom this in. We're going to look at this rally here. Now, Treasury yields should be moving up with the market if everything is healthy and everything's okay, but they have been warning since about January 22nd. The bond market has been spotting this growth issue where stocks have been just celebrating the Fed going dovish and all the other central banks. So let me put the 10-year yield. Actually, I'm going to move to a 60-minute chart. So here's the SPY. Here's the 10-year yield. Yields are moving up with the S&P after Powell went dovish here around January 4th. This is what you want to see if you're long, if you're bullish. When they start diverging like this is trouble. The bond market is disagreeing with the stock market. And a couple weeks ago, I said, pay attention to this about 2.62 level in the 10-year yield. Last week, as we saw, it broke below that level. So you can see it right over here last week. So as the market's rallying, breaks below it. Now on Friday, just absolutely dumped. Let me zoom in a little bit closer. Here you can see it on the week, a 5-minute chart of the SPY, and this is the 10-year yield in white. So as soon as the Federal Reserve FOMC came out, yields knee-jerked lower. That means treasuries went higher. And then here, no confirmation of that big rally on Thursday, and yields just dumped on Friday. 10-year yield was down 8 basis points. That's about twice as much as I would expect for how much the S&P was down. Huge disagreement between stocks and bonds. It was great for our TLT position, though. Let me see if I can show you the December 3rd pivot. This is kind of the same thing that happened, just a huge divergence between the two. That divergence has really been going on, quite honestly, as we saw, since about January 22nd. But until it broke that support last week, it really moved to a new level of concern, and then certainly, as you can see, after the Fed this week. So let me see if I can roll this back a little bit and just show you what I'm talking about, why this is a big deal to me. Okay, so here's SPY rolled back a little bit. Here's what we're looking at, this range. This is where that current kind of resistance zone is. So first leg down, big chops, big chops. This is into December 3rd's high. Again, this was on trade optimism, markets gapped up. And then this is the start of the second leg down, or the sell-off into December. So I'm going to throw a chart of the 10-year yield up. Hopefully you can follow this. This is that 60-minute chart now, so this is that kind of area of resistance. This is December 3rd. Here, the market gaps up. Just pay attention to what yields are doing here. They're not confirming. They're not moving up. And the scaling is going to look funny here for a second, but you can see they're moving down as the market moved up. This is how that December sell-off started. Yields basically led the market lower, as you can see here. So that's kind of the same thing that we ended up with on Friday. Here's TLT. I've been bullish on TLT. It's a little bit of a complicated setup, but if we look at this area here, and this is what I was kind of mentioning the prior week for members. So I'm going to walk this forward through the week. We've got a bullish kind of a pennant flag kind of consolidation. This is as of last Friday, so we walk forward, and on Tuesday you got a fantastic opportunity to buy right down here. I've been long this for a little bit, and then we got a start of a breakout. My target for this Okay, I have a much bigger plan here with TLT, but my target for this consolidation was 125. This is Thursday, starts to break out, and then Friday, boom. There it is, right up to 125. Been long this with some options for a while. I took off part of that trade. My overall gain on this was 250%. So I took off enough of the trade to pay for the entire thing and book some profits. So if my position goes to zero from here, I still make money. And I see a lot more potential here, but I think it's going to be, it might be a little bit tricky, but I think the best is still yet to come. Okay, let's see if we can wrap this up, put a bow on it. So we have the S&P here. I think this was a bull trap. Okay, so you had all these buyers taken out in one day. As a matter of fact, almost 2 weeks of buyers taken out in one day. The Fed has gone max-dovish. I mean, the next thing they can do at this point is a rate cut. Yield curves have inverted this week. Okay, so we have the 3-month and 10-year spread inversion. I will post a link to a video of President Trump's economic advisor, Larry Kudlow, talking about the significance of the 3-month, 10-year yield inversion. It has a track record of historically predicting recessions, 100% track record. But a lot happens between then and now, and there's some really neat ways of making money in treasuries as the Fed eventually slams rates back to zero. Remember that yields move opposite treasuries. That's why we did so well in TLT this week. The biggest takeaway from the yield curve inversion is a shift in sentiment from ignoring bad data this entire time to now starting to worry about it. And I'm sure you're going to hear CNBC or somebody say, well, there's no recession, likely in the next 12 months because it usually takes 12, 16 months, so buy stocks. I think we're a little bit past that at this point. S&P closed at the low of the day, also the low of the week. I think there's a high probability that was a bull trap. You're going to hear on CNBC, well, it's just a healthy correction, blah, 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 blah. When the second most heavily weighted S&P sector, financials, do this on this kind of volume, does that look like a healthy correction to you? Or when the front end of financials, regional banks, is down 10% on the week on this kind of volume, does that look like a healthy correction to you? Had the first correction here, bear flag. That, to me, looks like a sell-off, and this is what we've seen, through 2018 when the market sold off. It was stuff like regional banks that led lower here in September, that led lower here in December, and you can see it just doesn't look good here. Now, a couple things that you should be aware of. Here is crude. Okay, so it has rallied too off that December low over here with the market. Now, crude is one of the better places to be long when you have a growth slowdown and then the Fed makes a dovish pivot, because typically that weakens the dollar, and dollar-denominated assets like crude go up. I want to share something with you that I've long noticed. We're going to put up a chart of the 10-year yield. Now, when yields and crude diverge, like we have here, this is the 10-year yield, from the last 2 weeks spiking lower, that's not a good sign, because this is all about growth expectations. The bond market is basically puking on the stock market's interpretation of growth expectations. So watch when we kind of just roll this back a little bit. You see that the 10-year yield and crude, because the 10-year yield does reflect growth expectations, they move together. Another thing to be aware of that I've been talking about this last week is watch what the dollar does. The Fed has gone pretty much max dovish at this point without cutting rates, and the dollar has held up. And that is causing some trouble in a few areas. First, let's take a look at USDJPY, the carry trade, the US dollar versus the Japanese yen. Here it is. This is the daily chart. So what you'll notice is it has rallied off this December, January low with the market. Okay, let me throw up a trend line. So here we have a trend line. Here's the rally, and here is a break last week. So this is, while the USD is actually strong since the Fed, it has regained all the knee-jerk losses. The US dollar versus the yen, you see a safe haven flow or unwinding of the carry trade that is used to finance stock purchases. So if we look back to the last time it broke trend, okay, it was right over here. That is the December market sell-off. So it rallied with the market, and it just started breaking down this week. I'm going to take off the trend lines now that you see kind of where these breaks are here and here. This is selling off with the market, and I'm going to overlay the S&P real quick. So here's the S&P in white. You can see this is the January 2018 high. This is where the market started to sell off in September, October. Actually, October. The market consolidated, the S&P consolidated, and here's that December leg lower, and you can see that was enough of a sell-off to really spook the market and knock USDJPY lower, the yen higher versus the dollar. And let me just throw the trend lines on again. So there you see it, December, and here's what happened last week. So this is another big warning sign that carry trades are being unwound, that there's more safe haven flow into the yen versus the dollar. And since emerging markets have been such a popular trade, I've talked about this a lot with members on the website. I'm just going to throw it out there because it's been a very popular trade to be long emerging markets. Watch out for what the emerging market currencies are doing. They tend to lead the stocks. So here's the US dollar versus the Turkish lira. This is actually the lira selling off relative to the dollar. Here's a big triangle consolidation. A lot of times these fail, and instead of being a bullish consolidation and continuation, when they get this big, they can often be tops. So this failure here is what allowed emerging market stocks to rally. During this area, they were selling off. So you see a huge move here in the Turkish lira, higher on Friday. The dollar, South African rand. Here's the rand selling off versus the dollar. Here's the consolidation that calmed everything down and allowed emerging markets to rally. You can probably see it's a huge bull flag, which implies that it is going to break out and head higher, which it started to do. And there's the FOMC knee-jerk reaction. Initially dollar lower, that reversed, and now it looks like we are going to see emerging market currencies sell off, and that's important because they lead the stocks. Finally, because you're probably going to hear some crazy stuff from the financial media, like I said, there's no recession probable in the next 12 months, according to statistics. So buy stocks. They are always bullish when the market is up, and then when the market is down, you have these flashing red chyrons that the market is, in trouble. But they won't tell you that. They'll tell you, the day before to buy all-time new highs, and then the day after say, oh, it's big trouble. That's not the kind of information that's useful to me. What is useful to me, and this is what I showed you last week, I have the S&P 500 here in red and green candlesticks, and I have Dow transports relative to the Dow Industrials. This is Dow theory coming back from almost 100 years ago, where we have relative weakness, warning signs, relative weakness here, warning sign, and that has gotten worse, as you can see. Other areas, again, here's the S&P 500, and this is now financial sector versus the S&P. Relative strength, here you see the weakness. Over here you see the weakness, regional banks, just that much worse over here. And like I said earlier in the video, I'd rather know what international paper is doing than what Apple is doing. And, here's why. Look, relative weakness here at the top, actually relative strength here at the bottom, and relative weakness here again. So to me, there's just much more information out there. If you look for it and you don't become a zombie listening to CNBC. Now, don't get me wrong, this is still a very tough market because it is transitional. It's going through these huge spasms, especially the last 2-3 weeks. Again, look at what small caps are doing. That's where I have the bulk of my short position, is in small caps. Relative to this trend support here from the February 5th, 6th pivot, small caps have broken through that already. I think there's a really good chance that this has really been a bull trap, sucking in all that retail money, and the pros have been scooting out the back door. So we got this 2,800 level coming up next week. I think Apple has a big event Monday that the market's going to be paying attention to. It's never a good thing when the major averages close on the low of the day like we see here. So I'm going to leave it there. Again, I don't have high hopes for the market on Monday, being that we closed at the lows of the day and the week. But we will see some chop, and there'll be some opportunities, and I am going to leverage up some of my shorts. My most notable one is small caps. So I will see you on Monday. Have a fantastic weekend.